the profits of a business carried on by all or any of them acting for all. Persons making an agreement to carry business for common purpose are called partners individually and collectively called as firm. The name under which their business is carried on is called the firm name. Next, we know about the essential features of partnership. There must be an agreement entered into between two or more persons. The object of the agreement must be to share the profits of a business. The business must be carried on by all or any of the person concerned acting for all. It is formed to carry on a lawful business. The last feature of partnership is it is an association of persons, two or more persons. That is, the number of persons constituting a partnership must not exceed 10 in case of banking business and 20 in other business. Next, we know about the meaning of partnership deed. It is a document or the instrument containing the agreement between the partners is known as partnership deed. In partnership deed, some informations are given in the partnership form. The first information is name of the firm and the nature of the business. Next one, name and address of the partners and duration of the partnership form. Next, the partners invest the capital and share of each partner. It also mentioned the ratio of sharing profits and losses. Next, the partner's capital should be followed fixed capital or fluctuating capital method. It also be mentioned in the partnership deed. It also informed whether any interest is to be allowed on partner's capital for interest on capital or interest on drawings, etc. The amount of salaries and allowances, if any, payable to the partners, it also be included in the partnership deed. The period after which the final accounts are to be prepared, it also mentioned in the partnership deed. Whether decision in the case of Garner versus Murray is to apply in case of insolvency of a partner, it also mentioned in the partnership deed. In the absence of partnership deed, the rules are applicable in partnership form. The first rule is profit sharing ratio. Profits and losses are to be shared equally among the partners. The next one, interest on loan. And any loan apart from capital advanced by a partner, he and she is entitled to interest on the same at 6% per annum. Next, the interest on capital. No interest is to be allowed on capital. If under the agreement interest is to be paid, it will be allowed only when there is profit. In case of loss, no interest can be allowed. Next one, salary to partner. Partners are not entitled for any salary or other remuneration. Last one, interest on drawings. No interest is to be charged on drawings. It should be noted that partners may change any of the points mentioned above by the agreement. Next, we know about the meaning of profit and loss appropriation account. Profit and loss appropriation account is an account prepared by the partnership firm to distribute the profit among the partners. All adjustments reducing to partners like interest on capital, drawings, commission, etc. should be mentioned in the partnership deed. Next, the purpose of preparing profit and loss appropriation account. The main purpose of preparing profit and loss appropriation account of partnership firm is to collect and distribute the divisible profit and loss account of the partnership. Next, we know about the methods of preparing capital account. In partnership firm, they follow two methods. The first one, fixed capital method. The second method is fluctuating capital method. First, we discuss about the fluctuating capital method. Under this method, the capital account of partners does not remain at its original balance but fluctuates quite frequently. The reason is that all adjustments in respect of drawings, interest on capital, interest on drawings, salary or commission to partners, share of profits or losses are made directly in the capital account itself. So there is changes in the capital accounts of the partners. So in this method is also called as fluctuating capital system. Next we know about the fixed capital method. In fixed capital method, they prepared in two parts. The first part is partner's capital account. The second account is partner's current account. In partner's capital account, it's creditor with the original amount of capital introduced by the partner into the business. It is to be credited subsequently with extra capital introduced by the partner or debited with the amount of capital permanently withdrawn by the partner. No other adjustments are made in this account. The second part is partner's current account. It is maintained for making all entries relating to interest on partner's capital, drawings and loan, share of profit, partner salary and commission, etc. The balance in this account will go on fluctuating, but the balance of the capital account will remain fixed. So this method is also termed as fixed capital system. Thank you.